Hello and welcome to this latest edition of Courses on Demand brought to you by Forex Academy. In this course, we will be discussing those real-life case studies considering fundamental analysis. Now, there is, of course, inherent risk when deciding to trade the financial markets. So just before we begin, please do take a moment to familiarize yourself with the following disclaimer. So what are we going to cover exactly in this webinar? Well, we're going to discuss the overall economic environment of the markets that we trade. And then we're going to break down some really key or significant economic events through the course of the last 10 years that really made a huge impact in actually changing how traders perceive the markets, changing the overall formulation of risk on or risk off approaches to investing and trading, and obviously provide us with opportunity both in the long term and some volatility in the short term as well. In terms of our study as fundamental traders, or I suppose students of the markets, it is essential that we know what we're doing in these environments, and that leads us on to discuss whether we're deciding to trade the bond markets or Forex pairs. We need to know how these large economic events will affect the perception or the real decisions that other market participants will involve themselves with when deciding to put on positions and trade these markets, and that is no different from ourselves. So let's delve into really discussing first and foremost the trading, the economic environment and the trading of the macroeconomy. So why does this matter? Why does the economy matter to us as traders? The financial markets reflect the overall performance of the economy. Financial equity indices represent the overall business health of an economic region, and their strength or weakness bears a close connection to gross domestic product. Other asset classes, such as commodities, bonds, and stocks, are therefore affected by the level of business and investment activity circulating in the economy. Okay, so as an overall growth perspective, in terms of trading the economy, or those financial analysts out there, they look to the GDP, the gross domestic product, to see whether we're in a recessionary recovery or perhaps a boom period of growth. And that will indicate to us how strong an economy is in relation to its competitors as well. How do large economic events help shape the global economic outlook? And that will be the point of our lesson here. Large economic events can fundamentally change the way in which investors and traders perceive future economic growth and stability. They often cause a dramatic change in the level of risk and uncertainty over asset pricing, and that's both in the short term and long term. And we have seen that quite significantly in some of the topics we will discuss during the webinar: the Brexit decision, the massive depreciation of sterling, the US election there with Donald Trump caused a lot of volatility, and then we've seen a total repricing of assets as well. So let's delve into this in a lot more detail. But first and foremost, as us as traders, how do we perceive, or how do we read the news? How does it affect our opinion perhaps on the economy, whether we have short ideas in terms of trading an asset like perhaps a global equity index for a 2-month period? How do we actually take this economic news in, or these shifts in global sentiment, into our trading? Let's look at this for a moment. We have a trader here concerned about some figures that he has heard or seen sort of releasing into the news. The US economy expanded at an annualized 2.9% on quarter in the last 3 months of 2017. That's higher than 2.5% in the second estimate and beating market expectations of 2.7%. Personal consumption expenditures or privately inventory investment are revised up. Okay, so we have the personal consumption expenditures and private inventory investment are revised up. So we're sitting here as traders, we're involving ourselves in this economic environment, looking to make trading decisions. How do we speculate, and how do we really try and gather an understanding of what this means? Well, this could cause volatility in the Forex markets, of course. In the short term, we can see different pricing in terms of what domestic nation we're trading. If we're trading the pound against the US dollar, we need to know if that is a US increase in gross domestic product, how that might affect the dollar in relation to those other currencies. Obviously, we might look to trade the equities or buy. We've got a long US equity trade here if we have positive growth in the US economy as well. So there's our light bulb sparking off some new trading ideas. And that is what we do as traders. That is how we understand trading this economic environment. So let's look at what we have here. We sort of touched on it in some detail. US GDP growth rate, and we have EU unemployment rate. Two charts to the left-hand side. Our job as traders is to really bring this information over the two charts to the left onto our price action chart to the right and speculate, get involved trading these markets. So first and foremost, GDP growth. Well, we have a figure there relative in the last quarter of 2017, quite strong with 2.9%. We can see how it relates to overall performance throughout the year. Is it perhaps a beat in terms of estimates? We know that it was. That will lead us to actually look for buying opportunities, and we can see the market has reflected in such a way. We look then perhaps for EU unemployment rate. It is continuously over the long term going down. That is a good sign for us traders here in Europe who are considered to trade more often those European indices or perhaps Forex pairs or any sort of relevance in terms of European markets. That is supposed to be and certainly will be in terms of fundamental decision making be supportive. So that's what we do here in terms of trading the economic environment. We look at these economic events or these economic data to formulate trading decisions over the medium to long term. In delving in, understanding more about the economy, we will become better traders. Now let's delve into our real case study number one, which is, of course, Brexit. I'm sure most of us are very familiar with the situation. It was due to a referendum there on the 23rd of June 2016. The UK voted to leave the European Union. This was a massive shock to the financial markets, not only because most had expected the UK electorate would overwhelmingly support staying within the EU, but because it would have astronomical ramifications in how the UK would conduct business and trade with its neighbouring economies. Okay, so that's going to have long-term effects on trade relations. In the short term, it generated a huge level of uncertainty over future trade relations, continued economic growth, employment and immigration between nations, and of course political discord, which might I say continues today. Such a fundamental shift in domestic policy for the UK government was sure to have very real effects on the financial markets, particularly those securities related to Britain. So the question I would like to pose when we decide to fundamentally analyze these case studies is what fundamental changes took place and what trading opportunities did it provide? And that's really the point of fundamental analysis as well. Remember, it's not to necessarily be correct, it's to make trading decisions and look for those opportunities in the marketplaces. So first and foremost, obviously an event of this magnitude, of this scale, is going to cause short-term and long-term sentiment volatility. Whether you're a Forex trader, you're going to know that's going to cause more opportunity for you, or whether perhaps you're holding long equity positions in the UK or across Europe, obviously that's going to have a really negative effect with the volatility in the short term on your position, and potentially could lead to some future opportunities in terms of speculation in trying to price in this Brexit scenario. And obviously then the most immediate effect felt in the financial markets would have been the depreciation, the quick depreciation in sterling from around 147 to 132. So quite a drastic move. And obviously that led to a more longer term approach in terms of long-term depreciation in the currency. That led then to a re-evaluation of the UK economy, and obviously if you're an equity trader, to total repricing of UK equity markets. So obviously we've seen a short-term volatility. Fundamentally, we know that's going to cause a lot of concern in the financial markets. But as the markets start to reprice these moves, these economic case events that we study, that leads to a total shift or a total repricing in such assets. In particular here, as we discuss the UK equity markets, just think of ourselves as potential UK equity investors, perhaps only owning a portfolio of stocks there in the UK. All of these shares are going to be revalued based on the change in the actual currency itself, the indicative currency that these are priced in. So let's look at the chart here in front and actually assess this fundamental case in a little more detail in terms of the price action. Well, in front we have the pound US dollar Forex cable market, and we can see obviously the big engulfing candle that sticks out like a sore thumb there, a depreciation or devaluation of that currency from 147 to 132 almost overnight. So we have it a 10.2% drop in a 48-hour period. That is of real concern for Forex traders, particularly obviously if you're trading those currency pairs valued across the pound sterling pairs, and obviously those assets that are related to those pairs. So any real commodities that come from the UK, whether they're import or export commodities, any assets such as the equity markets mentioned would have been gravely affected. And this is obviously going to change the entire sentiment of the market in the short term as the market starts to really reprice the risks, reprice the uncertainty in terms of how the political discord will ensue and what it might mean for economic growth within the Eurozone. Here we have the Brexit shock then. We can see the intense volatility there just by observing the candlestick structure, the Japanese candlestick structures. During the weekend, obviously, we see the FTSE closes on Friday evening at 6,358, and after the weekend, or after the Brexit referendum vote, it opens at 5,770. So that's sort of mid-range in that very large candle there. You would have seen the daily price action trade down, and as the markets start to reprice this move with the currency devaluation to see how it actually affects some of the big earners in there, the export boom companies, starting to actually reprice the performance of the FTSE as an equity index. We see the price move up quite sternly, and obviously in a 3 to 4 period come back up to new levels. Then we see the Brexit aftermath. The markets totally revalue the composition of the FTSE 100 index as suggested, and traders pricing that future value of export boom growth. And this inevitably is something that is quite a shock to the market, ironically leads to a period of boom within the UK economy in terms of the market structure, repricing those assets, and in terms of actually looking at the trend in front, we can see it actually fundamentally, this fundamental case serves to support economic growth to the upside. So let's move on to our real case study number 2 and discuss the Swiss National Bank. The Swiss National Bank is responsible for the monetary policy of Switzerland, just like any other bank. It does aim to provide growth and stability of the domestic economy by working towards target inflation rates and price stability. Considering the geographical significance of Switzerland, it is very important that the nation has strong and perhaps favorable trade relations with its European neighbors, even though it does not share the domestic currency with the single euro mechanism. The SNB, or Swiss National Bank, announced on the 6th of September 2011 that it intended to address changes in the value of the Swiss franc to the euro, aimed at depreciating the currency cap to 120 so as to remain competitive to its neighbors. Then, on the 5th of January 2015, the Swiss National Bank made an unexpected announcement to the markets that they believed the euro crisis had passed and that they were no longer following the euro currency arrangement. So let's take a step back for a moment and try and assess this scenario fundamentally for the nation of Switzerland. If we think we have at this time a euro crisis where we have negative interest rates across some regions, and obviously there's a lot of concern that this euro sovereign debt crisis is going to deepen. We see a country geographically like Switzerland right in the center of all this controversy, and they want to continue their growth and continue their business amongst the calamity. What they'll want to do, if we think of the composition of the SMI, which is the Swiss Market Index, the leading equity index there in Switzerland, we have companies like Nestle, the chocolate maker, then we have Novartis, Roche. Some of these companies are huge exporters in terms of global demand and obviously would do most of their business in the Eurozone. So now that we know fundamentally the reason for the Swiss National Bank pegging their currency to 120 euro, and obviously the aftermath of actually pulling that peg, how can we assess them and look to see what happened in the currency markets? Well, we have here the euro Swiss franc, and inevitably we can see an absolutely huge move to the downside. That resembles a huge amount of fear and uncertainty And obviously, the fact that it was such a sudden announcement is going to cause increased volatility to the downside. We've seen literally the floor has been pulled from this market. The support has broke at 120. Fundamentally, that was the case. And really, the notion or the directive from Thomas Jordan and from the Swiss National Bank to actually send this currency back to a level of equilibrium in terms of national domestic currency in relation to the eurozone. It's its biggest partner in terms of trade relations. Let's move forward then to discussing our real case study number three, and that is the infamous collapse of Lehman Brothers. So, if you have been a financial trader or just genuinely interested in the markets and the economies over the past 10, 15 years, or generally just interested in the financial recession and crisis that we had there, this is certainly a case study of interest. Lehman Brothers was one of the largest investment banks on Wall Street. It was perhaps the first big bank to capitalize on the growth of the US mortgage organization market, where massive amounts of profits were being made on US home loans. By 2006, it had merged with many active lenders across America, so much that it had appeared to do almost all of its investment business in collateralized real estate and only a portion in traditional financial investment. This era of investment growth coincided with the rise of the shadow banking industry and financial leveraging that monumentally increased Lehman's exposure to the mortgage market. So, in a little detail, if you're unaware of the shadow banking industry, you may have seen the movie The Big Short. It's simply where all of these financial firms learned to package bad debt together, reprice it as good debt, and sell it on throughout the financial system. So that led obviously to all of this being joined collectively and spread systemically throughout the system. Times of economic boom ensured that such investments were profitable. However, the significant portion of its assets allocated to managing housing loans meant they were vulnerable to a market downturn, and of course, more vulnerable to an eventual market downturn in the housing market itself, which is eventually what happened. During the later months of 2007 and early 2008, it was clear there had been a housing bubble, all led by the easy availability of credit and the ease at which it was to get a mortgage loan accepted. Property prices quickly began to fall, and millions of mortgages became unaffordable and unpayable overnight. And that happened. Millions of Americans where their homes, effectively their mortgages, turned into negative equity over a very short space of time. While enjoying profits during the boom, Lehman's over-leveraged exposure to the mortgage market meant that a 4% decline in the value of its assets would entirely eliminate its book value of equity. On the 15th of September 2008, Lehman Brothers filed for Chapter 11 bankruptcy protection. It had accumulated a total holding of over 600 billion in US assets. $600 billion in US assets, quite a substantial amount. The collapse of Lehman Brothers was not only an economic disaster for the US housing market, it brought into question the systemic risk these financial institutions caused to the entire global financial system. And that is certainly really the study of this case and really the bullet point in terms of being a student of the financial markets. When you study the shadow banking industry and these banks, the question at the time was, are these banks perhaps too big to fail? And of course, there was discussion at the time between those in government and those in the private sector whether they could actually float or keep Lehman Brothers above water and how that would actually affect the financial system. They agreed at the time that they simply could not. They obviously went on to bail many other banks out, but let Lehman Brothers evidently collapse, it being the largest investment bank on Wall Street. So, very significant period of history in the US. Let's look at how this real case study, the actual collapse of Lehman Brothers, affected the markets. In looking at the economy, we have here the S&P 500 daily chart over a long period of time. We can see the market downturn shows us a lot of volatility, and that is representative of the serious amount of concern or uncertainty that market participants and traders are feeling as we see the fresh news flow, perhaps mortgages denied, housing sector fallouts. All of these things will come into the news and cause volatility to the downside. So we see the downside with the realization of the housing bubble itself. It became clear banks and financial institutions were indeed overexposed, but particularly the size, the too big to fail phenomenon, really affected the downturn and was the catalyst for price movement when it became clear that Lehman Brothers was simply not too big to fail and that the entire banking system was indeed in jeopardy. And that's what we've seen in terms of the price follow through that inevitably caused the catalyst for the 2008 global recession. In some more detail, in terms of analyzing this fundamentally, what does this mean for us as traders over the long term? We know that as investors in the community, you'll generally go through 4 to 5 periods within your own lifespan, obviously considering how long you live. But we do go through the business cycle periods of booms and busts or slumps. And obviously, there are intermittent recessionary periods within that. So, here within GDP, we have our boom and bust cycles. We see the collapse of Lehman Brothers just enter the markets there, causing a bit of a catalyst as the markets reprice this whole phenomenon. We see a large investment bank take the hit, collapse due to the massive mortgage exposure in this space, and then we obviously see the slump with our financial crisis there, 2008, continuing on to even deeper slump periods. Now, in aiming fundamentally to analyze why exactly, or one reason why we were able to come out of this recessionary period and back into a recovery or period of economic boom, we can study real case study number 4, and that is quantitative easing. Quantitative easing programs were first introduced by Japan in 2007 to battle deflation in the economy. The aim was to flood the domestic market with new liquidity to promote lending and stimulate the economy. So, generally speaking, they do this through the bond markets, through the new issuance of debt. As a result of the global financial crisis of 2008, many global economies still faced financial meltdown with worsening economic conditions and limited credit availability. At the time, we referred to this as the credit crunch. So, for many traders out there, I'm sure you're familiar with the phrase. There was intense volatility in the Forex markets as well as the equity markets. And of course, we felt this, everyone felt this in terms of a pinch on the pocket. With the objective of boosting the economy in the United States, launched a program of quantitative easing in 2008, followed by the UK in 2009, and of course, the European Union later the same year. Each central bank took on large-scale asset purchases, assuming the burden of risk for their economies, and released fresh, healthier liquidity back into the markets in order to stimulate lending and growth. So let us refer back to our business cycle. What we are trying to do is actually recover from this economic recession, this global financial crisis that has systemically affected our financial institutions, caused unemployment across many, many nations, and effectively slowed growth. What we are effectively doing is trying to stimulate growth by increasing the money flow into the economy, swapping bad debt with good debt, and trying to increase lending so that consumer spending, growth, and employment regains its stature in our economies. Here we have the financial crisis, and coming on from that, with the period of slump there, we introduced QE1. That's commencing in November 2008, with the US Federal Reserve started buying $600 billion in mortgage-backed securities and $1.7 trillion of bank debt. Then we have QE2, that's November 2010, and that's another $600 billion of mortgage-backed securities in that purchasing program. And then, of course, September 2013, the US Fed launched $40 billion a month open-ended bond purchasing program, and that is to flood the markets with new liquidity to increase that lending in the private sector across the corporate finance world. And then after a prolonged period of perhaps 6 years of quantitative easing, we see these factors start to come into effect where money supply is increased, it is filtered through the rest of the economy. We're starting to see these financial institutions become healthier. They're starting to lend more to small business enterprises, who in turn create business, hire staff, which actually increases the labor market. and then obviously consumer spending and manufacturing start to grow as well. This all leads to the total financial recovery story, and we're currently obviously just coming into a boom period where we've seen a very strong market bull run for the last 2 to 3 years. So, how did the financial markets react to this fundamental story of quantitative easing? Well, obviously, they know fundamentally they're going to be supportive by the government, and that is the primary concern or issue with QE. More generally speaking, market prices are said to be um, discovered. Price discovery is a function of participation between buyers and sellers. So, this is a very unique period of our history where actually government institutions and central banks directly interfered with that price discovery over the long term. Obviously, it's in an effect to help the economy and stimulate growth, but in terms of pricing assets, it led to support and obviously long-term price structures to the upside, given the economic growth and health of the economy. So here in front we have the S&P 500. This is the largest equity index in the US, consisting of the top 500 companies by market capitalization. To the left, we can see obviously the financial crisis caused a huge shift of market sentiment, and obviously we see the inevitable recession that we have, bringing prices way down to new lows there, February 2009. Then what we see is a period of recovery just after, but it does take time for that recovery to come in. And obviously, this is a fundamental discussion of quantitative easing. How long will it come into effect? How long will those prices and changes start to feed into the economy? But we do see sustained growth over the long term period when looking at our S&P 500. Given that this is a global financial crisis, the question I would like to ask and really view and observe is, how does it affect the rest of the global equities out there in the world? Let's have a view. Here we have the Nasdaq 100. We can see that the price structure is very similar. We have the FTSE 100 again. We have a very strong move to the downside, and we can see as we move across all these global equity indices, the larger story of quantitative easing is a function of actually looking to support global growth. That is a very similar story in terms of the fundamental base of quantitative easing, but we can see there are little time shifts, and that's more relative to the fact that QE was introduced earlier in the United States, then in the UK, and then in the European Union. We see these prices start to stabilize and inevitably move to the upside over the long run. So let us delve into our real case study number 5, the European sovereign debt crisis. The European sovereign debt crisis took place in the European Union towards the end of 2009, when it became clear that most Eurozone economies were still struggling with the challenge of economic recovery. Many nations had seen an increase in sovereign debt as a result of banking system bailouts and were unable to pay or refinance their government debt. So that is the key when really understanding the function of debt or interest rates, the ability to actually repay those debts or loans over a long period of time. To understand the complexity of this situation, we must understand how inextricably linked long-term interest rates are to macroeconomic health. A nation's interest rate reflects the risk associated with its ability to lend to the financial markets. So, of course, in layman's terms, those countries who have a higher perception of risk, perhaps they're going through tough times economically. In this particular case, we have Ireland, Greece, of course, Italy, Portugal. They were finding it very difficult to repay their debts, and obviously that risk involved in actually purchasing a loan, perhaps a 10-year bond from one of those governments, has an added perception of risk and obviously would require a repayment of a higher level of return. So it is a simple risk reward ratio when deciding how bonds are priced and level of interest rates to those bonds. With many EU nations unable to refinance their debt, massive uncertainty entered the bond markets, causing dramatic volatility and a surge in many domestic interest rates. This effectively collapsed the bond markets in some countries and led to a huge increase in unemployment for those worst affected. So, effectively, what we were witnessing in the European sovereign debt crisis was the inability for many of these nations to effectively pay back their debt to the European Central Bank. Many of these countries had obviously taken bailouts and were given bailouts by the ECB to help stimulate domestic growth in their national economy. But of course, these are loans and these have to be paid back. When the economic performance of these nations didn't seem to grow in the same perspective of the bailouts, and obviously they were experiencing a serious level of austerity and difficulty in doing so, in growing their economy and recovering, those challenges came to the front where effectively it was very difficult to pay back and make their obligations in terms of paying back debt to the European Central Bank. So let's look at our case study chart here. What we have is long-term interest rates over the period July 2008 to January 2018. Now, in analysing our long-term interest rate chart, we can see that there are two countries that really stick out for us, both Portugal with the blue line and Ireland with the green line, respectively. What this chart tells us really is that there's a large spike in interest rates over the period roughly July 2010 to October 2012. That would present problems for Ireland and Portugal in terms of trying to refinance their government operations in the bond markets, given that they would have to pay back a level of percentage interest on perhaps 10%. We have 12.5 a peak in Ireland there, roughly around 13-14% peak there with Portugal, reflecting, of course, the overall uncertainty or perhaps perception that they could not effectively repay these loans or their bonds back in a given period of time. And that all constitutes the level of risk these economies are facing at the moment. One of the countries not included in our long-term interest rate chart, given it's a real case study in terms of studying European sovereign debt crisis, is Greece, of course. Greece had been hit very hard by the financial crisis, and its trouble to remain competitive as a euro trading partner in the eurozone was really pushed into question. And this is because really they got bailed out time and time again and could not repay their debt and almost went bust several times. So what I'd like to do is actually pinpoint this, and I'll put it in black that we can annotate it ourselves here. We have April 2010, 8%, which is in and around this period, we have around 10%. We can see already that it is leading the way in terms of this increased volatility and long-term interest rate spike to the upside. That is, again, just simply an overall reflection of the uncertainty, of the peril of their economy at this stage, and their inability to effectively pay off any debt that they may assume. Then we have April 2011. If we scroll up and actually look to plot the point, we have it around 13%, so that will just be above here again. It's going to plot a high from our Irish debt at that point. And then April 2012, 27%, which is an astronomical figure. And I'd like to detail that just to in terms of what it means for the financial markets, in terms of potentially loaning or looking to borrow from the Greek economy. 27%, we have April 2012, that is up here. And again, we'll just put it at the top of our chart. What that means effectively is if you were to assume some finance from Greece and effectively purchase at the time, hypothetically, one of their 10-year bonds, they would effectively be paying an interest rate on the bond of 27%, which is an astronomical figure in terms of generally pricing a bond and obviously paying an interest over a long period of time at 27%. It's absolutely huge. So that just shows you the level of risk or uncertainty the financial markets priced in when understanding the level of peril the Greek economy was actually in at this time. So all of these fundamental cases serve actually to help us as traders, not only for the knowledge, they serve to really give us an idea of the overall economic environment within which we trade. It is the job of the financial trader to speculate on the movement of price. These prices relate to many different assets, but all share a very common relationship to the performance of the global and domestic economy from which they are natured. We cannot, therefore, effectively do our job if we do not have a fundamental grasp on how economic events can shape the very environment we ourselves conduct business in. Once we better understand the effects of news and economic activity, we will become more knowledgeable about our trading conditions and therefore more assured in our trading decisions. So that brings us to the end of our Real Case Studies Fundamental Analysis webinar. Let's go over a quick review of what we learned through the webinar. Trading and the economic environment, why it is so important to understand and grasp the overall economy and how it changes the risk on, risk off approach to your trading, and really how it affects all of these different assets that we trade as financial traders. We then went through different case studies over the last 15 years. We have Brexit, the Swiss National Bank removing the currency pegged to the euro, Lehman Brothers, and effectively a lot of detailed discussion on the financial crisis of 2008. That led us effectively into discussing the recovery mechanism of quantitative easing, and then we touched upon the European sovereign debt crisis, how that may affect liquidity, and how it certainly affected the bond markets and perceptions of risk for domestic economies and potentially the Eurozone growth perspective overall. So all that is left for me to do is thank you very much for joining us on this installment of Courses on Demand brought to you by Forex Academy. We do hope to see you very soon. Bye for now.